Let's recap. When talking about expenses and the recognition of those expenses, we have three cases. The first one, case one, cash comes before the expense. In this case, our asset cash goes down, and whatever we bought, the supplies, for example, that asset would increase. And then when we actually use those supplies, we decrease the asset as we use them and move it to an expense. Case two, you pay cash at the same time as the expense. It's like paying for your electricity as electricity is used. Your cash goes down and your expense goes up. The last one is when the expense happens before we pay, in which case this isn't a liability. This is an accounts payable. We owe somebody money. We expense it, record the liability, and then when we pay for it, our cash will go down and then our liability will go down. Now remember the basic accounting equation from Chapter 2. That is, asset equals liabilities plus stockholders' equity. And remember those debit and credits that we talked about last chapter. All asset accounts increase on the left, or the debit side. And then they decrease on the right, or the credit side. Liability accounts increase on the right, or credit side, and decrease on the left, or the debit side. It's just the opposite of the way assets increase and decrease. And like the liability accounts, stockholders' equity accounts also increase on the right, or the credit side, and then decrease on the left, or the debit side. I'm going to introduce some new accounts here. We know that stockholders' equity includes common stock, and that's given to stockholders when they contribute capital to the company. And then there's also retained earnings, which is generated by the company itself through profitable operations. Retained earnings is the part that expands to include revenues and expenses. Remember that revenues minus expenses equals net income, or net loss. Think of revenues and expenses as subcategories within the retained earnings. They are shown this way because revenues and expenses eventually flow into the retained earnings, but they aren't initially recorded there. Instead, each revenue and expense is accumulated in a separate account. Making it easier to identify the amount to report for each item on the income statement. Because revenues and expense accounts are subcategories for retained earnings, they are affected by debits and credits in the same way as all stockholders' equity accounts. And you already know that increases in stockholders' equity are recorded on the right side. You also know that revenues increase net income, which also increases stockholders' equity, which goes into retained earnings. So putting these ideas together should lead to the conclusion that revenues are recorded on the right with a credit. Decreases in stockholders' equity are recorded on the left side. So to show that expenses decrease net income and then retained earnings, expenses are recorded on the left side with a debit. Let's do some examples. Return to SonicGateway. In September, SonicGateway sold $3,000 of games at its online store. If we analyze the transaction in this case, cash, an asset, increased by $3,000. And then sales revenue, a subcategory of stockholders' equity, increased by the same amount. The general journal entry is to debit or increase the asset account for cash, and then increase sales revenue for the same amount. which is a credit. We summarize the transaction by entering the effects of the journal entry into the general ledger T accounts. Cash will increase by $3,000, and then the sales revenue account will also increase by $3,000. Our debits equal our credits. SonicGateway issued 3 $100 gift cards at the beginning of September. If we analyze a transaction, this case, cash, which is an asset, will increase by $300 because we sold those gift cards. But now we introduce the unearned revenue account. We haven't done anything to earn those gift cards. The service has not been rendered. So legally, it's not our money. We have to put it as a liability. The general journal entry is to debit or increase cash, and then to credit the unearned revenue, a liability account for the same amount. And we can summarize those in our T accounts. Our debits equal our credits. SonicGateway sold $9,000 of apps in the App Store and on Google Play. This is one of those situations where they didn't get their money yet. They'll get it later. We put the $9,000 in an accounts receivable account. We'll receive that money later. And then we will also increase our revenue. The general journal entry is to debit the accounts receivable account because it's an asset, and then to credit sales revenue because it increases also. We summarize the transaction in our T accounts. Our debits equal our credits. Here's an expense example. SonicGateway received checks totaling $8,500. Oh man. Here's another revenue example. SonicGateway received checks totaling $8,500 from Apple and Google on account. So here's the actual payment that we received from Apple and Google for the revenue we earned earlier. We already recorded the revenue. Now we can record the actual cash. They paid us $8,500. We had $8,500 sitting in the accounts receivable account because we knew they were going to pay us later. Now we can reduce that account. Cash goes up, accounts receivable goes down. Summarized in our T accounts shows that debits equal our credits. Here's an expense example. SonicGateway wrote checks to employees totaling $7,800 for wages related to hours worked in September. We actually paid cash. Cash came out. And here expenses increase. The entry would look like this. Salary and wages increased, and it's a debit because it makes stockholders' equity go down. And our cash went down, and it's an asset, so we decrease it with a credit. This is what it looks like in our T accounts. Remember, salaries and wages expense is part of those stockholders' equity accounts. And we decrease stockholders' equity with a debit. On September 1st, SonicGateway paid $7,200 in advance for September, October, and November rent. Cash came out, but the asset prepaid rent increased. That's an asset account because we didn't actually have to pay our rent yet. It's still our money. Prepaid rent increased and cash decreased. Prepaid rent's kind of a funny account. Just remember that it's an asset. No expense has been incurred yet. It's still our money. SonicGateway displayed Facebook sidebar ads in September and received a bill for $500 to be paid in October. In this case, we received a bill. So this should be familiar from the previous chapter. we owe somebody money, so our liability will increase. But because we actually had an expense rendered, our stockholders' equity will go down. We're going to debit our expenses and credit our payable. SonicGateway was notified by its bank that an automatic monthly payment of $600 was transmitted to its utility company for the electricity used in September. Now that we've actually paid the utility company, at the same time that our expense was incurred, we can go ahead and record cash coming down and the expense going up. Remember, the expenses decrease stockholders' equity. So our expense will be a debit to stockholders' equity. Cash will come down, and that's our credit. The income statement provides the main measure of a company's operating performance. The key thing to look for is whether net income is positive. That is, revenues exceed expenses. Beyond that, it's useful to consider whether revenues are growing faster than expenses. If so, the company's net income will be increasing. For this, we use a ratio called the net profit margin. It expresses the net income of a company as a percentage of its revenue. Currently, SonicGateway's accounting records report revenues of $12,000 and expenses of $8,900. That's the sum of all these expenses. And we are looking at the trial balance here. That's why you see all those different accounts. Remember, the trial balance is just used to make sure our debits equal our credits. Now, if we had revenues of $12,000 and expenses of $8,900, then our net income is $3,100. This $3,100 of net income is 25.8% of the $12,000 of revenues. This net profit margin implies that SonicGateway earned 25.8 cents of net income from every dollar of sales revenue. These measures are preliminary and will change when the accounting records are adjusted at the end of September. When comparing the profit margin between companies, make sure you do it in the same industry.